An index fund is a fund that broadly tracks a market. It is made up of equities and bonds, and the fund manager's objective is to closely track the market as much as he can. There are a number of benefits that are certainly attractive to investors. One is the reduction in costs. Because you're simply just tracking the market, there's not too much trading that goes on. So lower costs mean that more of your money is left within your investments, and the compound effect of that over time is significant. We'd also suggest that there's a reduction in risk. Because you're simply tracking the market, you're not trying to speculate or outperform things. And what we're looking for is a long-term investment with reduced volatility. Over recent times, the amount of money that's gone into index funds has become significant. And in fact, recent estimates suggest that over 50% of new funds are actually going into index funds as opposed to active funds. Of course, that does raise the question from an academic perspective, is there a bubble? In reality, if we look at things through a bit of a lens, we do see that the majority of publicly listed companies are still actively traded quite a lot. And it's important to distinguish the difference between the asset price and price discovery. So just because there's a large amount of money within a fund doesn't mean that the things that make up those funds aren't still actively being traded on a day-to-day basis. So I would certainly argue that there isn't a bubble, and price discovery will always exist because some of these, the constituents of these funds, these bonds, these stocks, will still actively be traded. It's a very interesting question, that what would happen if everybody was index investing? And firstly, I think that's very, very unlikely. There's always going to be a demand for speculation, for active management in some areas. People are always going to try to beat the market. So I think that's unlikely that it's ever going to happen. Could there be a scenario where the numbers get to such a stage where it does have a direct impact? Maybe that will open the door to active management having a role. But the evidence clearly shows the returns that you get from index investing far outperform active management on a risk and cost adjusted basis. The investment fund management industry is a multi-billion pound industry across the world, and fund managers make an awful lot of money. It's no surprise that the advertising you see, the promotions that you see are all about active management, the next big idea, the next big name. It's quite boring in a way and uninteresting to have an indexed investment approach. But it's the old adage, slow and steady wins the race. When we advise clients, it's about that long-term approach to investment. We're not looking to try and shoot to the stars. It's about having a proven, demonstrable, evidence-based approach to investment that gets those clients to their goals and objectives.